Hello, this is a video on Forex and commodity trading, whereby we shall learn what is commodity trading and Forex trading. On commodity trading, what you need to know is that you trade commodities. These include wheat, include coffee, include other commodities like sport good and the like. In Forex trading, you exchange currencies. For instance, Euro USD, you have USD card, you have Kenya shillings against the dollar, and all that. For commodity, it is worth noting that you buy a commodity or you sell a commodity. This one means that in case you are a seller and you're dealing with rice, you wait for someone who is in need of rice and you exchange it with cash or money. This can be currency in your country or the common currencies or the hard currencies, which include the US dollar, the GBP, and the like. When you come to the Forex trading, or as the name suggests, it means a foreign exchange. In this case, you exchange currencies with each other. For instance, you can exchange the US dollar against the shilling. You can exchange the Great Britain pound with the Kenyan shillings or the Tanzanian shilling or the euro. Now, what is the difference between the commodity trading and the forex trading? In commodity trading, for instance, tea or coffee, you use money to buy that coffee, or else if you're a trader, you sell that coffee. When it comes to currency trading, we have what we refer to as the base currency. When a pair is arranged, for instance, in our case, you have Euro USD. This is 1 minute chart. The euro here is our base currency. That means you use US dollars to purchase the euro. In case you have the euro, you sell it and you get the US dollar. When you come to something else, for instance, you have this chart for the US dollar and the Canadian dollar. What you need to know here in this case, the US dollar is the base currency. The Canadian dollar is now, the US dollar is behaving like the commodity here, whereby you use the Canadian dollar to purchase or to buy the US dollar. Or else, if you have US dollar, you sell it to get the Canadian dollar. Therefore, in this case, USD or the United States dollar acts as the base currency. When you come to this other chart, this is UAD or the Australian dollar and the US dollar. In this case, the US dollar is the base currency, meaning that you purchase it using the US dollar, or else you sell it to get the US dollar. Therefore, in this case, when you are a trader, the AUD or the Australian dollar, you sell it or you purchase it using the US dollar. In case I give an example of an African country, for instance, Kenya, where I am, you have USD KES, whereby the base currency is USD or the United States dollar. Therefore, you will use Kenya shillings to buy the dollar. Or else, if you go to the bank with US dollar, you sell it to get the Kenya shilling. Therefore, in that case, the US dollar is your base currency. What happens in the bank is you find that there is a chart showing how much is being purchased or how much is being sold by the bank. When you look at the case of Kenya and Tanzania, you will find that the KES or the Kenya shillings will be the base currency. Therefore, the TZ or the Tanzanian shilling will be used to purchase the Kenyan shilling, or else If you have the Tanzanian shillings, you will buy the Kenyan shillings. If you have the Kenyan shillings, you shall sell it to get the Tanzanian shilling. And that is the slight difference between the US dollar, the base currency, and the other currency in a currency pair. And that is still how the commodity trading differs with the forex trading. If we add something on top of that, there is one thing that is common when it comes to trading, and that common thing is what we refer to as the price of that commodity. You will find, for instance, a dollar, for instance, in Kenya is being purchased currently at around 150 shillings. Therefore, when you have 150 shillings, you can manage to purchase $1. If you have $1, you can sell it at around 150 shillings. Therefore, the key thing here, or the common denominator, is the price. Now, let's look at this chart, whereby I want us to get to the 1 minute time frame for AUD USD, or the Australian dollar USD pair, whereby we have what you can see on the screen. Let me start from the basics, whereby we shall start with how we present the price in a graph. The first thing is what we refer to as a line chart. The line chart plots the closing prices in during that time frame. For instance, this is a 1 minute chart. Every minute, after every minute, the chart closes. After every minute, you will find that the price crosses, and there is a point at that point. From there, it will move, the price will move up and down, as you can see it is doing. After one more minute, the price will close again. That will continue throughout the chart. As you can see, the minute has jumped and the price has closed at this point. This is the simplest form of representing price. The second way of presenting price is what we refer to as bar charts. And in the bar charts, as you can see, we have bars, long ones, which has a protruding part on the left side and a protruding part on the right side. Now, what does this mean? This simply means that the dot or the protruding on the left, that was the opening price for that bar during that time frame. For instance, this one, the prices opened here, perhaps it moved down a little bit, and then it moves up, yeah, and then up again. After moving up and down, the price closed at this point. This dot here is the opening price of the next bar, and perhaps this price moved down, it moved up, down, up, and then it closed at this point. And usually in Forex, the next dot on the next candle simply forms the opening price of the next bar. Therefore, the price will move up and down, and then it closes at this point. Therefore, when you look at a candlestick, it has, a bar chart or a bar, it has several details as opposed to a line chart. It will have the opening price, it will have the lowest, it will have the highest, it will have the closing price. That's another method or way of presenting the same information. When we come to the last way of presenting the information, we have the candlesticks. A candlestick has several parts. We have this part that is quite thick, which we refer to as the body of the candle. The upper part, that line, wick. The lower part, we equally call it a wick. When you look at the candlestick, you will have several details. You will have the lowest price during that time, the highest price during that time. You will have the closing price for that time, and you have the opening price for the same. As you can see, For the next candle, this one candle is green, the other one is red. One is a bullish candle, the other one is a bearish candle. When you look at this second candle, you will have the price opened at the top, moved down, and closed at this point. This simply means that the opening of the previous candle, the big green candle, the closing of the big green candle, and the closing of the next candle is that the closing of the second candle is lower than the closing of the first candle, and that forms a bearish candlestick, meaning the prices went down after the closing at this point. That is what we refer to as a candlestick. Mostly in forex trading, in what I shall be teaching you on technical analysis, usually we do not use the line charts, we do not use the bar charts, we usually use the candlesticks as they give more information.